Hello friends, how are you doing out there? This is Vijay Bhambwani and I'm back in my weekly video with you taking care of the market outlook for the coming week. I must thank you again for the tremendous response, especially in the last 3 weeks videos that you have given me. Lots more connections on social media, a lot of healthy conversations going about the markets, and sure enough, I'm trying to cater to the discerning, the knowledgeable, the deeply thoughtful investor / trader in my videos, and which is why it's basically generating a lot of interest amongst the people who want to stay ahead of the market, because we are looking at a well-rounded 360-degree view of the market, looking at everything that impacts the prices. And in that tradition, I'm going to continue in this week as well. Friends, before I begin this video, I have an important announcement at the fag end of the video, important update rather, at the fag end of this video. So don't go away. Stay tuned till the very end. This is a critical market update and it's going to impact your cash portfolios and as well as your open trades. So we're going to take a look at that at the fag end. So in my recent video, I said the mutual funds would not allow the markets to fall, but the retail traders would not be trading too much because of March ending, and this is so typical of the financial year ending. March is the last financial month of the fiscal year in India, which starts from April and ends in March. And therefore, you'll have the usual pull and push, the high bouts of volatility. And what a volatile week it was. Friday will go down in memory as an extremely volatile day where the Nifty opened so low and then closed with over 200, almost 200 points of gain. So you were very well warned by these videos, and I'm going to keep you adequately protected in my coming videos. And guess what? The market roundup on your screen shows you that the Bank Nifty fell more than the Nifty. And viewers of my videos are not really surprised. You know why. It's because the Dixie rose, the bond yields spiked before they closed marginally lower, and inflation remained a concern, which is not something that too many people are discussing. It's only now that people have woken up to the idea that bond yields matter. So as the roundup screen tells you, the only thing which is not red is the US dollar index and gold and silver. Bullion saw safe haven buying because financial assets witnessed a sell-off. The fact that oil and gas fell also provided a cushion to our markets, which would have otherwise fallen a lot more harder. Remember, crude oil and natural gas is something I called multiplier commodities. They drive up the prices of everything from fruits, vegetables, conveyance, transport, milk, eggs, etc., etc. So it's not very surprising that the markets didn't fall as much, because these two items did not really rise at all. Now, bond yields spiked midweek but settled down marginally lower on a week-on-week basis. And like I said, I have an important update related to this issue at the fag end of this video. And coming up on your screen now is the MWPL chart. It fell on a week-on-week basis because traders cut their exposures due to two reasons. Number one, the market started turning very jittery. And number two, we have the derivatives expiry coming up, which is a routine matter, therefore, to see MWPL fall ahead of the expiry. The volumes chart of both the index and the stock futures, and this is a cumulative expiry, which is March, April, and May, shows that volumes actually shot up, because the traders actually participated even during the down days. So savvy traders and investors are not only selling but short selling at appropriate levels which is what is driving up volumes. And check out the basis chart on your screen. You will see that both the indices, the Bank Nifty and the Nifty 50 on a 20-day compression look back basis, both are showing basis has contracted because of the selling pressure. And this also had a trickle down effect on call option premium, which eroded rapidly. Now, partly you could attribute this to the approaching expiry also, but there's no mistaking the fact that the selling pressure kept the basis down. Let's take a look at the impetus chart. Now, these are all studies that are not available in the public domain. These are from our in-house trading model, the Barracuda, which is also updated on my social media accounts every day. Feel free to connect with me. My contact coordinates will come at the end of the video here. So the impetus chart shows that the markets were basically gaining steam steadily on a look back period or a time period of 20 days, which means the selling pressure was actually gathering momentum. And the primary reason the markets are not in a free fall is because of March ending. And like I told you in my recent video, mutual funds resort to NAV boosting, and which is why they don't allow the markets to go down very sharply. Now, these are aspects which are not being discussed very openly in the public domain, but we don't really mind sharing our trading systems, our trading thoughts with our friends on social media, and we do open our doors to our in-house studies one step at a time. So stay tuned, stay connected. You're going to learn a lot more out here. Now, the market roundup done, let's proceed to the 10-year benchmark bond yield. Now, this is something that I have been talking about for many, many months ahead of the broader markets. Look at the way how the 10-year benchmark bond yield spiked in the middle of the week and then reacted lower because the RBI governor gave a rap on the knuckles to bond traders. Do remember that the RBI wants to lower rates so that it can raise up to 12 lakh crores from the bond markets in the coming financial year, which will start from 1st of April, for the government's cash flow and working capital requirements. And bond investors and bond dealers don't want to deploy funds at lower rates. RBI is comfortable with 5.8, 5.9, 5.95. But the investors and bond dealers want more than 6.5%, which is unacceptable to the RBI. Now, this is a pull and push, which will keep the equity markets nervous, and you need to watch this space for more updates. Now, this is something, the bond yields and all are also something that I update on my social media account every day. And please feel free to connect with me so you can stay up to date on this front as well. I maintain my view that you should continue to watch the US dollar, the 10-year benchmark bond yield, and the inflation, irrespective of what you're told about these so-called boring topics. But if you love your money, you'll realize that you need to watch any and everything that impacts the price. And no one actually does as good a job of guarding and safeguarding your money as you yourself can. So stay alert, stay sharp. Friends, let's now go to the Dixie. Now, this US currency benchmark continued to stay firm and pushed emerging markets, equity markets lower. That included, unfortunately, the Indian markets also. Now, we want a weak dollar because India is an import-dependent nation. We are net importers. And if the dollar is strong, it results in what the economists call imported inflation. Note how on the daily chart on your screen, the 25-day exponential moving average acted as a fairly reliable support in a down phase. And the closing was about 95.50, which I did talk about even last week. Any breakout above the 92.60 level is what needs watching. And should that occur, the bulls might just force the bears to go for a short squeeze or panic-driven short covering. Now, if you check the weekly chart, it shows the price closing above the 25-week exponential moving average all over again. The 92.60 level remains the hurdle for the bulls to cross on whichever time frame compression you take the chart at, weekly or daily. Now, last week I advocated a potential range between 92.85 on the upside and 90.5 on the downside, which held perfectly well. And the coming week may see an estimated, I stress upon the word estimated, range between 93.05 on the upside and 90.80 on the downside. Now keep watching this index closely for cues even on the equity markets in India if you want to stay ahead of the broader markets. Friends, the Dixie done. Let's now go to the Bank Nifty, which underperformed the Nifty, and by now you know the reason. I've conditioned you to think far ahead of the broader markets. You know that the bond yields, the US dollar index, and the inflation kept this benchmark below. The price is well below its 25-day exponential moving average on the daily chart on your screen, and the index itself took support at the trend line itself, which is a dashed blue trend line, and the support came very well here on Friday. The outlook remains shaky and selling pressure at higher levels may be expected in the coming week. Now, I wanted the index to go above a previous swing high before we could even think of going long, but unfortunately that did not occur. And therefore no longs were triggered last week. In the week before last, this index was at number 4 on the volatility list, but it's climbed to number 2, which means the statistical beta or pure price volatility of this index has risen by 2 notches, which makes this index fairly tricky and treacherous to trade because volatility is so high. The 35,000 to 35,500 price band, which means this 500-point band, will become a resistance zone. It is called a ceiling test in professional traders' parlance. And this band needs close watching, and it should be overcome on a sustained closing basis, not just intraday basis, before you can go long again for swing trades. The weekly chart on your screen shows a large, prominent bearish candle which will pressurize the bulls on advances, since higher levels will see overhead supply coming from traders which are stuck with long positions which are currently losing money. And the price even now stays above its 25 weeks exponential moving average on this weekly chart, which means that the long-term trend still remains upwards, and it is the short-term trend which is cloudy, but only as of now. A lot can change, which is what I want to discuss with you in my week's video at the fag end. This is the critical update I'm talking about, so stay tuned till the end and don't walk away. Now, last week I advocated a range between 37,350 on the upside and 33,625 on the downside, which was violated marginally because the weekly low was 33,361, and I'm talking about the spot segment. The coming week is likely to witness an estimated, I again stress on the word estimated, range between 36,050 on the upside and 32,250 on the downside. The range appears wider because of the high base effect of last week's highly volatile markets. Now, I continue to remain watchful and would suggest that my friends trade light and enforce your stop losses diligently, because these are not markets you want to trifle with. Friends, the Bank Nifty done. We now go to the most liquid and low impact cost counter on the NSE derivative segment, the Nifty 50 index. Now, this index fell relatively lesser in comparison with Bank Nifty, and even though on the daily chart on your screen this index looks like its price is definitely below its 25-day exponential moving average, but the situation is not half as grim as it was on the Bank Nifty. Like the Bank Nifty, this index also took support at its short-term blue dashed trend line on Friday itself, and no previous swing high was overcome last week, and therefore no buy got triggered. Do remember that the impetus was rising even on declining days, which warns that the momentum on the downside is picking up speed, which means sell on rallies or exit on rallies will be the possibility even in the coming week. Now, to offer some relief to the bulls, the price must break out above its 25-day exponential moving average, as well as staying above the round number of 15,000 on a sustained closing basis, not just intraday but sustained closing basis. Look at the weekly chart on your screen. The price remains above the 25-week exponential moving average, and it has logged a big bearish hammer just like the Bank Nifty. Now, this indicates that the long-term trend remains up for now, because the price is comfortably above its 25-weekly moving average. In the week before last, this index was number 8 on the most volatile counters list. It remains unchanged there. And last week, I advocated a range between 15,600 on the upside and 14,040 on the downside, which was breached on the downside because the low was 14,350. Now, in the coming week, I foresee an estimated, I stress upon the word estimated here, range between 15,325 on the upside and 14,175 on the downside. I would caution my friends of the higher statistical beta, which means the volatility is too high for lots of retail traders. Therefore, trading on small exposure would be the sensible thing to do. The Jensen's measure still remains hostile for fresh, long leverage trades. So go slow on buying and enforce your stop loss very diligently. Now, the last remaining two segments of this video are the top 5 most volatile counters and top 5 least volatile counters for traders to trade. This is the most popular segment of this video. The high beta, high impetus counters where you take small exposure but wait for larger price moves is led by Ramco Cements at number 1, number 2 Cipla, number 3 Dr. Lal's Path Labs, number 4 ITC, number 5 Sun Pharma. Note how 3 out of the 5 counters are related to personal care and the pharmaceutical industry. The low beta, low impetus stocks where you take big exposure and wait for small price moves is led by Bharti Airtel at number 1, number 2 Dabur, number 3 Manappuram, number 4 Hindalco, and number 5 IndusInd Bank. Now friends, for the critical update that I have reserved for the last is that the RBI on Friday has announced that there will be a provision for marking negative yields on government bonds in the online trading system. So what it basically means is that the RBI is definitely looking forward to pushing bond yields lower and therefore interest rates lower. I'm sure all of you would have watched my video how to think like FIIs, which I had uploaded on Wednesday last week. Do please take a look at that video. It will tell you what FIIs look at before investing in this country, and interest rates and bond yields are a major domo trigger point. Now this is exactly what the RBI is trying to change. If interest rates in India are brought down, the carry trade means here is an economy which is lending money at say 1% and India is taking money at 6%. An FII would borrow money from here at 1% and invest in this country, in India, at 6%, thereby earning an arbitrage, gross arbitrage. It's too simplistic a view, but that's fine. A gross arbitrage of 5%. Now, this is called the cash carry trade. Now, if we were to reduce our interest rates, the big question I have in my mind is what happens to the carry trade? If FII inflows were to slow down, the market will lose upward momentum. Now, this is something that I want my viewers to learn to think for themselves. And in my previous video about don't look only at FII numbers before you trade, I gave you a hyperlink of the NSDL website where FII inflows and outflows are updated every evening past 6 p.m. Please monitor the FII flows very, very carefully now that the RBI has officially announced that they will want lower interest rates. I am a little concerned about how the cash carry trade is going to pan out and how much inflows we will get in that situation. I'm keeping my mind open, but definitely keeping my ears to the ground to watch the situation. So friends, coming up on your screen are my social media contact coordinates. Feel free to connect with them. We'll get conversations going. I upload a lot of simple but highly accurate statistical updates on my social media accounts. Connect with me and we'll get conversations going and exchange a lot of market related ideas. Friends, if you like this video, subscribe to my YouTube channel. Click on the bell icon to receive instant alerts of fresh video content being put up here. In the comment section, do let me know what you think about this video and help me spread the word of knowledge-based investments and reach out to thoughtful intellectual traders by referring my video to your family and friends. Have a very, very profitable week ahead. This is Vijay Bhambwani signing off for now. Thank you for watching my video. Take care. Bye-bye.